Well, the inflation numbers came out Tuesday morning and the CPI came at 7.1% year over year. On top of that, the month over month inflation rate came in at 0.1%. Core CPI month over month came in a little higher at 0.2%, but that was still the smallest advance in over 15 months. Now look, back at the beginning of this year, when I started saying that the Federal Reserve was actually going to raise rates and was actually going to lower their balance sheet, everybody said I was crazy. Here we are a year later almost, and that's exactly what they've done for this entire year. And a few months ago, when I started to say that inflation was going to come down, because if you look at the way that monetary policy works its way throughout an economy, there's a big lag. The reason why raising rates and letting assets bleed off their balance sheet hasn't affected inflation meaningfully yet is not because of the degree or the significance or the severity that they're just not doing it enough. It's because there's about a 1-year lag between when monetary policy happens and when it actually hits the broader economy. This is why when the money printing started in February of 2020, it took a year until March of 2021 for the CPI to come back to where it was at for the 3 years prior. This is why when we look at assets like gold skyrocketing today, silver up today, Bitcoin up significantly today, the S&P 500 starting higher today, and the Nasdaq still holding higher today. Meanwhile, yields on the 2-year are dropping, the 10-year are dropping, and the 20 and the 30-year are both down. This is because the market recognizes that we are likely over the hump of inflation numbers shooting higher. Now, do I think that the market is justified in these asset prices going up? No, I think that a result of inflation coming meaningfully down at the start of 2023 will also mean that we have a severe slowdown in earnings and we have a recession and we have economic hardship. So I think the markets will then react to that news within a quarter or so. But there's no denying the fact that month over month inflation has been extremely subdued compared to what it was since the start of 2020. This all comes back to the money supply, which, as we can see, has not moved for about 1 year. So is 7.1% anything to celebrate about? Absolutely not. We are probably going to see the Federal Reserve and the current political administration start to take victory laps and say, hey, we've brought inflation down. No, 7% inflation is still way too high. That means you have to get just about the average of the stock market's returns on your money for the last 50 years just to break even on your purchasing power. That's a bad deal for every American. What I am saying is this number is about to get way lower. Now, we know that the Federal Reserve is meeting this week on Tuesday and on Wednesday. Powell will give his press conference to announce their next interest rate decision. And it does not look like this new inflation data is going to be changing their short-term path. It looks like they're still probably going to raise interest rates. The expectation is that they'll still raise interest rates by 0.5%. We're also likely to see the Fed funds rate hit about 5% at its top. However, when you look at pricing, you can see that traders are now expecting a higher likelihood of only a 25 basis point increase in interest rates. So if I'm right, we are about to see a big slowdown in the inflation rate, and I don't think that's necessarily a good thing because of the way I think the Federal Reserve will inevitably eventually respond to it. I do think that zero inflation and deflation consistently, persistently over long periods of time is absolutely the best thing that any normal person could hope for, unless you are somebody who is stealing the wealth away from normal people like a central bank or a government through inflation. Then you want inflation. Other than that, if you want the best thing possible for an economy, you want slow, persistent deflation. You want a system that incentivizes savings and punishes spending because that increases savings, which is the pool by which investments are derived from. And investment is the tool that increases productivity, which builds wealth over a long period of time. So while it does decrease consumption in the short run, you build a much larger pool of wealth to draw from, which means consumption ultimately increases far larger than you could have over an inflationary system. But unfortunately, that's not the direction that our central bank is looking to go. And if we do tip over into deflation, we are much more likely to see them panic and try and take over and step it back up to inflation, 1%, 2%, according to their words. But we are not likely to see them just allow deflation to continue, even though that would be better for most Americans. So ultimately, I do think that the monetary policy we've seen over the last year has been sufficient to stop inflation because money supply is what causes inflation and deflation. It's a monetary phenomenon. And so when we haven't seen the money supply increase over the last year, that means that eventually that will result in a slowdown and a complete stopping of prices going up. There's just not enough money continuing to increase to continue pushing prices up. Prices will plateau. But ultimately, this spells long-term disaster because I think the Federal Reserve will start to take victory laps. Then when everything spills over into a big crash, they're going to overcorrect the other way and not allow the next round of deflation or crash or recession to happen and burn out the deadwood like it's supposed to. Ultimately, we will see what happens, and come February or March, you're definitely going to hear from me on whether or not I'm saying I told you so, or I'm going to have to eat my words and say I was wrong. In the meantime, know that it's likely that no matter what happens with inflation, it is very likely that we see another leg down in asset prices, especially as earnings start to come out much lower than has been priced in, meaning that we're still in a bear market. And if you'd like to know how to identify the best companies in the world and then figure out what prices they're actually on sale, what prices would be good prices to buy them at, discounts and values, get my bear market investing guide on sale for $99, linked in the description below. As always, I really appreciate you guys. Thank you so much for watching. Have a great day.